So let's zoom in here. All right, so right away, I want you to take a look at that wick right here. Now, why am I even referring to this one? Like, why would my eye jump to that? Why would your eye jump to that? Well, after the market starts to dive down here, where's the swing low? Here. This candle, and this candle. But this has a long wick or tail in this case. And what I like to do is I like to measure from the open down to the low. 50% of that is consequent encroachment because I teach you that a wick, whether it's below or above a candlestick, is to be treated as a gap. Draw that out in time. You can see during Wednesday's trading, we traded up here and hit that, went just a little bit above it, and came back off of it. The other point of interest is this volume imbalance here. So between this candlestick's open, this candlestick's open, there's no bodies laid down. There's wicks that are overlapping, but that's my volume imbalance. And then we opened here and traded up through it and up into the premium wick of this candlestick here. What makes this market environment presently difficult? Well, the fact that we're having a whole lot of like separation between the settlement prices, this right here. So you have to focus where all the volume imbalances are. And that's where you start. And when price was down here, you have to look up above from this low up to that high, look through all that. So you had this volume imbalance. So when we started the week, looking back through all this, you can see that volume imbalance there, fair value gap with a volume imbalance. So technically it's this open to this high, but that's a PD array for another time. And then you have this volume imbalance there. And then price did in fact trade up into this area once before, but PD arrays are meant to be used more than once. Okay. Premium wick consequent encouragement of this candlestick right here on the daily chart for NASDAQ June delivery contract 2025. And this volume imbalance right here. Okay, those are the only two reference points on the daily chart that I'm going to have on the lower time frames. So if you're on my Telegram channel this morning, we opened up the session with obviously a very large gap opening, which is denoted here from previous day's settlement. So that large gap there, generally it's usually within the scope of reasonable for it to continue moving in the direction of the extreme opening gap, in this case, moving higher. But so let's drop down lower time frames. Here's a 5-minute chart. And you can see how the market did in fact trade up eventually into and above that daily premium wick consequent encroachment level. And the market then gave up the ghost, went lower, and traded back down into that daily volume imbalance. It's in yellow. And then went into a range bound consolidation. All of these wicks here, look at all this back and forth. See all that right there? This is what I was anticipating when I said turn your charts off. So just know that while price was going back and forth like this is extremely difficult to trade in unless you have such a large stop. Here's the 1-minute chart. And here's the first percent of fair value gap right here. And you can see the market does in fact rally up, comes back down, lots of ugly price action in here. And I said that we would likely see a draw back down into the first percent of fair value gap. That was a probable draw, meaning it's going to pull back down into that. That was me setting the stage for something like this move here, dropping down into first percent of fair value gap, then up into a PD array that I would have given you at a subsequent later time, but you know, as it were, we had all this back and forth price action. I mentioned that we pretty much can expect that they have ran out all the shorts and the market started to break lower. I went short on this candlestick. I will show you the execution in a moment. Then I mentioned this fair value gap. It traded up into it, started to sell off, got real close to first percent to fair value gap, and then it does this return back up into it, and then bang, one more time. Then false rally drops down into the first percent to fair value gap, then creates an imbalance here, trades to the daily premium wick consequent encroachment, creates a drop into the macro, and then we have one more time a premium wick consequent encroachment. That's right here. You can see the body's respecting that. The wicks are allowed to do damage. As you can see, they did a lot of damage in here on a 5-minute chart. And then during the 1050 to 1110 macro, we start to see it sell off. Nice little bearish order block with a SIBI right there, which is an institutional order flow entry drill. 3 PDA rays all in one. What I just said, play it back again. Write down in your journal. That is a model in and of itself if you have a bias. The market breaks lower, trades into this inefficiency that becomes an inversion fair value gap. Another premium wick consequent encroachment here inside the inversion fair value gap, and tanks down into first percent fair value gap, which will extend in a moment on the next slide. This will be extended over here and trading down into the daily volume imbalance, and then below the sell side that I mentioned this morning in the Telegram channel, and into that fair value gap. So it does that right here at 11:30, which begins the lunch macro. So I want you to take a look at this candlestick right in here. And there I am shorting 4 at 19,108. And there's a little symbol telling you exactly where at on that 1-minute candle. So it opened, traded up a little bit, and then started its way back down below this high. So that was my turtle soup. I was mentioning that it was technically a turtle soup environment, meaning that it's a false breakout. Buy stops have been taken, and I'm looking for a drop back down into first percent fair value gap for partial one, which would have been 2 contracts. That's how I would have done it today. And then I would have taken one below here, and then I would have left the remaining to be taken below here. That's how I was going to trade it, plan it. And now you'll see this is where I got stopped out on this candlestick. And I had literally just dropped the stop just above this little high here. And you can see on that candlestick right there, that's where I got stopped out. This would have been a loss. Like it would have been a loss altogether. The stop loss opened up on the position 3 ticks above this high. Okay, so it was really, really thin in terms of the amount of movement I wanted to allow it to go against. This type of thing's going to happen to you. You may get a trade on in a day like this and suffer a loss. And then later on, see it do where you thought it was going to go to a specific level. And you get mad. You get tore up about it. You get emotional. Those guys did it to us guys again. Okay, so the first percent fair value gap here acts as an inversion fair value gap here. Beautiful. This looks like it touches it, but as you zoom in on it, it gets just real close to a tick or so away and then rolls over, which is actually good because you want to see them fail when it's weak. And if it can't even touch the PD array and starts to sell off, then it's wonderful. Take the first fair value gap, and that would be right in here, which is an overlap of that daily volume imbalance here. And then trades down into the lower quadrant of that daily volume imbalance. And then we started banging around inside that and then traded outside of it here. And later on in the afternoon, you can see that's that move outside and below the daily volume imbalance. And it creates a sell side liquidity pool. The market rallies up, creates the runs off of the quadrants on the daily volume imbalance. It's that yellow shaded area. That's the level I started with at the daily chart. Then it rallies back up to first percent of fair value gap, trades back down into the daily volume imbalance. Here's the afternoon session, first percent of fair value gap. It trades up into this morning session, first percent of fair value gap, and then drops down below it. And right in here hits it, starts to work lower, and one more time, but during a macro, 250 to 310 hits the first percent of fair value. Tongue twister.